The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alistair McLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alistair McLeod on behalf of Gold Money, and this is a three-way podcast. With me today I have, in the very, very far west, Ron Hera of Hera Research, who is in Seattle. And somewhere in between us, I have Jason Burack of Wall Street for Main Street. And the topic of conversation which we want to address is deflation, inflation. What is inflation? How does it work? And therefore, what are the dangers ahead of us? And what are the likely outcomes? So anyway, welcome, gentlemen. It's very, very nice to speak to you both.
Good morning.
Good morning.
Yeah, good morning, Alistair.
I think if I could start with you, Ron, can you make any sort of case for deflation, and how are you going to define deflation in that case?
Oh, absolutely. Well, yes, in terms of definitions, I think that the main definitions that we're concerned about have to do with the supply of money, and they have to do with credit, which in our modern context is essentially the same thing. Debt expansion implies an increase in the money supply generally. But of course, most people just refer to inflation and deflation as increases and decreases in prices. And I think for the purpose of this discussion, while we may talk about price increases, we generally are talking about the money supply itself, because of course price increases follow from changes in the amount of money that's in the economy. Now, in terms of deflation, I think that there's a fairly compelling case for deflation, because we had a huge bubble in real estate, not just in the United States, but also in Europe, to some extent in Canada. And that represents a massive credit expansion. And as Ludwig von Mises said, there is no means of basically prolonging that credit expansion, and it would lead ultimately to a collapse of the credit bubble or to a collapse of the currency. And that is what we're facing, is this sort of deflationary force because of this massive credit expansion. And we see the same phenomenon in terms of government debt, and that's after the financial crisis of 2008, which was substantially caused by this real estate bubble. We saw a massive increase in government debt. And so you have debt all over the place, and you see the same thing in the U.S. consumer or household debt, and that debt is unsustainable. In other words, there isn't economic growth to service that debt. When it comes to the government debt, there is no combination, at least for the United States and for some of the European peripheral countries, there's no combination of tax increases or economic growth that ever will retire that debt. So that is the case for deflation. In other words, this massive bubble has to unwind somehow. It has to be deflated.
So, just very, very briefly. So I think you're drawing a distinction between asset deflation and prices, if you like, in the high street. Would I be right in saying that?
Absolutely. I mean, the credit and the money supply is the main factor here with respect to inflation and deflation. And then, of course, prices tend to follow the changes in the supply of money.
Right. Okay. Jason, how do you see it?
Okay, well, besides just the normal conventional definitions for deflation, now I also consider deflation as free market forces. So you have the government-sponsored inflation, which is what the Keynesians want. The Keynesians want the inflation created because, they want higher prices. That's what they were taught in school. That's what they were taught in the textbook. And, they haven't tested their theories out, because the last time their theories were really tested was the 70s, and Keynesian economics should have failed after stagflation, which is something hopefully that we'll talk about a lot in this discussion, because, stagflation is something the Keynesians said could never happen, that high inflation and high unemployment could not happen simultaneously, because one of the transmission mechanisms for inflation is supposed to be, increasing wages, increasing demand, et cetera, et cetera. So in terms of deflation here, I think a lot of the problems are definitions that people have, because if you look, like Ron brought up with the debt, but the debt is not supposed to ever be paid back in real terms. The thing is, the way the money system is here, the world money system is that the money is printed to buy the debt and monetize the debt, and it devalues the currency. So it's a circular argument here where one thing comes in, something else comes out with the treasuries and the currency, and it's meant to devalue both. So that's basically what we have where, if you looked in the real economy, if you looked at separate categories like Ron mentioned, and you have money, you have credit, you have assets, you have consumer discretionary, and you have consumer staples, and you looked at all of those different categories from a certain perspective, you could see inflation in certain things like consumer staples, but you would see free market forces in consumer discretionary items because the purchasing power of people in the developed world is just massively decreasing. It's just massively decreasing, like I said, because their food and energy bill is going up. Their wages, if they can find a job, if they can hold a job, their wages are not increasing. So these are the types of like diverging factors that you have here. And in my opinion, when you look at things net, it results basically in a paper fiat money system. You have stagflation with the paper fiat money system in the real economy. You have assets being propped up on a nominal, the attempt of assets being propped up on a nominal basis, largely because of tax purposes and animal spirits. And then in terms of gold, that's where you have a basic deflation, in my opinion, where gold is gaining purchasing power against basically every single asset class.
Right. So actually, I think what you're sort of just very much shortening what you're saying, Jason. The only thing which actually reflects what's going on for demand generally is perhaps the prices of goods and services denominated in gold. Am I just cutting through the argument too strongly to come to that conclusion?
Well, gold is the truth. Gold is the truth there. It's not the lies. I mean, the lies with the statistics, with the government statistics for the CPI and the unemployment rates and the GDP and all those other things. But gold is the really true barometer. I mean, we could talk about how much gold is manipulated here, but gold is still, it's holding up very, very well. When people said it should have corrected even more violently. And ultimately, there are going to be a lot of firms that fail. I mean, the Fed's not going to be able to save every Applebee's here in the United States. I mean, there's going to be a lot of restaurants where consumer discretionary income and the shopping malls, the firms are not going to be able to cut back and run themselves as efficiently. I mean, look at Hostess. Like, you had a problem where labor and management were both like rating the company. The revenues and the earnings were not very good, and management was paying themselves a higher salary. The union wanted a higher salary too. I mean, this was a dual problem here, and Hostess is not the exception. There's going to be a lot of firms like Hostess. You're seeing a lot of discounting here from Black Friday for the U.S. consumer, where people, like, if they have a job, are barely spending, and the only spending that's really occurring is because the retailer is discounting everything so drastically, including the restaurants.
I think we're wandering slightly towards what the economy is doing rather than what money is doing. I know the two things are bound up, but I think there is a very sharp distinction between what's been happening in the economy. When I look at the level of unemployment in America and indeed elsewhere in the world, all I see is the signs of a depression, if you like, in the sense that instead of economic progress, we have economic regression. I think the money side is a slightly different thing insofar as fiat money as a means of measuring what's going on in the economy is actually a very, very bad indicator. It's changing all the time. The amount of credit and hard money in the economy is so variable from one moment to another that you cannot make comparisons. And this, I think, complicates the whole thing. But if I can pick up on one thing that you were touching on, Jason, there's sort of the Keynesian view and how they don't understand stagflation and so on. In my opinion, this comes from a poor understanding of price formation. And at the heart of this, I think they have taken the quantity theory of money, which was, I think, an approximation of what happened in the days when you had gold, or at least paper money freely convertible into gold, into a fiat money situation. where it cannot apply for the very, very simple reason that the only value that fiat money has in transactions is a supposed value which is based on the confidence that the people in a jurisdiction have in its government. Otherwise, it has no value. So what I'm suggesting to you, gentlemen, is that the value of your dollar, our pounds or whatever, can actually change very, very radically without any monetary relationships whatsoever. And as evidence of this, I would cite what happened in Iceland at the time of the banking crisis. What happened to the krona? It fell 70% over the period of 2 days. Now, that's not a monetary relationship, that's a confidence relationship. And surely that is at the root of all our paper currency problems, that it is entirely based on confidence. Would you agree there's merit in that argument, or do you take violent exception to it?
Well, I would say that while it is true that fiat money requires confidence in order to have value, that it is essentially has a subjective kind of value rather than an objective kind of value, because it isn't directly linked to any real tangible good that exists in the world. But at the same time, I think that the argument that would be made is that it's supply and demand, and that the supply of money and managing that supply of money has a vast influence over the economy. And that's exactly what is at the heart of the problem we see today, which is that Jason mentioned, for example, that there's this transmission mechanism, and what's happened is that we've seen a massive credit expansion, and then we've seen that expansion come to an end because essentially the capacity, the level of debt has exceeded the ability of the economy to sustain that debt. And it really goes back to the heart of the monetary system. So as long as, this idea of constant never-ending inflation, and that's okay, because of course you just always pay back debt in less valuable dollars, that is essentially the system that we have today. And that system will work fine as long as as long as the economy continues to grow. Think about it from the point of view of an individual business. If you can borrow money and expand that business and always pay back those debts with increased revenues, then you can continue to borrow and to expand indefinitely. But once the expansion stops, that debt then becomes essentially a millstone around the neck of that business and can even sink the business. And that's what's happened not just with individual businesses, but with the whole economy, especially in the United States, but also in Europe. And this has to do with the very nature of the monetary system, that it is a system that is inherently inflationary and that must expand. And we've reached the point where, since 1971, after about 40 years, we've reached a point where that expansion can no longer continue. And it has been a global expansion, especially from the point of view of U.S. companies, the global multinational companies. So, you have to look at the very nature of the monetary system and the fact that it's essentially has this idea of inflation and expansion built in, and that we've reached the end of that expansion. And so one might even argue that we've reached the some terminal point in this pure fiat monetary system.
Yeah,
well,
Jason, go on.
I would add to Ron, what Ron is saying there is that the private sector is the one that realizes quickly, except for the banking sector, that it's not very smart for them to continue expanding at the pace that they were expanding at. There's certain specific examples where the management is going to over-lever, and then you're going to have free market forces and the market's going to take the company to task. But the credit expansion that's still occurring is with the government sector. And that's because the government, believes in Keynesian economics. The government doesn't want to cut back on spending, even though it is, the government sees a revenue problem. Okay, unfortunately, all these governments see revenue problems, but the problem is not revenues. The government is cannibalizing. A lot of these governments, especially in the developed world, are cannibalizing their private sectors just so that way the government can stay the same size and grow. So we're reaching the point here, and I don't know if you guys will agree, and I think Japan is going to really put this to the test probably first, is where the Japanese government has run massive budget deficits here for a long time. Now they're running trade deficits. Their citizen savings rates have been sucked up for the last couple of decades. They haven't had much investing income. They've held cash, they've held JGBs. Their private corporations and citizens can't hold that anymore. So Japan's getting to the point now where if their government's going to be running these budget deficits and putting out more JGBs, the currency now is going to have to get trashed to soak up the JGBs. So I think Japan is going to be the model for what's coming for most of the developed world, where in order for the governments to continue issuing these massive sovereign debts, the currency is going to have to be massively trashed or devalued.
Well, Japan is an interesting one. Let's come on to that in a moment. But I just want to take slight issue on the bank credit side, because that is now expanding, and it seems to be picking up at a reasonable pace. If you look at the figures out of the St. Louis, the Fred figures. So that all this QE2, QE3 is now beginning to work through. But then there's a further problem on top of that, and that is the shadow banking system. There was a report issued by the Financial Standards Board in Switzerland, whose chairman, believe it or not, is the incoming governor of the Bank of England. But they reckon that the size of the shadow banking system in the United States was something like $23 trillion. Now, of course, none of this is recorded in the statistics. And the shadow banking system worldwide is growing quite rapidly in other centres, particularly financial centres like Britain. We've got $9 trillion, which is roughly 3.5 to 3 3/4 times our GDP. That's just in the shadow banking system, in addition to private sector debts, in addition to public sector debts. And so, trying to make sense out of these fiat money figures is, I think, pretty well impossible. What I see is, if you like, a huge, great inverse pyramid, an extra pyramid, if you like, with all this burden on top of virtually nothing, threatening to topple over, and it's very, very difficult to stop it toppling over. So if before we come on to Japan, I think if we can just sort of consider what is likely to happen, what is the way out of this, I can accept that there is likely to be a deflation effect on collateral prices. And we're particularly talking about bonds, which are in a bubble because of zero interest rates. We could also be talking about equities, which are rarely tied to bond valuations in a sense. And if the bond market bubble bursts, then there is no doubt that will have a very, very strong and negative impact on equity prices. And, of course, that means that the collateral which underwrites this shadow banking bubble, and yet another bubble, will topple the whole of the shadow banking system. So the only answer for this, as far as I can see it, is that sort of period of deflation would be met with an enormous acceleration in the production of raw money. Do you see it like that? How about you, Ron?
Well, that is what I think as well. And, I'd like to say with respect to Japan that those points are all well taken as far as what the Japanese situation is. And in a sense, they are going first into this new paradigm, if you will. But I actually think that it's really much worse than that, because in the United States, we entered this period of crisis with virtually no savings in the economy and with very high consumer debt levels. And what we saw when we essentially had the consumer credit card maxed out and the crisis upon us in terms of the natural market force of deflation, what we saw was the government literally step in and almost dollar for dollar replace the expansion of consumer credit with an expansion of government debt. And so this, in fact, bails out this keeps the system going. I mean, this actually continues a bankrupt system. So going back to the Mises quote, that is what would ultimately lead to a final and total catastrophe of the currency system. We're not abandoning further credit expansion. In fact, we're trying to reflate the credit bubble and keep the deflation from happening. And this is what's causing these huge monetary distortions. And we're talking about not just trillions of dollars, but tens of trillions already on a global basis. And that is where I think we really have a massive flood of money developing. And the question is, how does that play out in terms of the transmission mechanism? So there's one argument that, when you look at these trillions of dollars sitting in banking system, that this wall of money could sort of flood out like a dam breaking and like a tsunami of money and smash the economy and the value of money, and prices would go crazy. I think the Fed, at least in the United States, has very good control over that, because they can control bank reserves as well as, even though interest rates are pegged at zero. So I'm not sure that would be the result. But really, I think there's no way to disguise the degrading value of money. And so that is the situation, that whether you say that you'd have this toppling of the shadow banking system or some other crisis, some black swan like the OTC derivatives, unwinding like in a domino effect, and that the response would be the sort of massive money printing. That's in a way that is kind of what's been happening. It's just happening in a relatively slow manner, and so it's unclear whether or not this inflation would take place very quickly, or if it will be a long, drawn-out process that essentially leaves the economy in a stagnant situation where you have this sort of cost-push inflation from never-ending money printing. So global commodities just sort of creep up in price because, of course, there's still demand in the developing world, while at the same time, the erosion in the value of money essentially prevents the economy from growing. It destroys savings. It prevents capital formation. It deprives pensioners of interest income. And so you end up with stagflation. And that's, I think, very much what we see in the United States. And it's not a situation that I think is coming quickly to a head. It's rather a long, drawn-out situation that could literally go on for years into the future. Not like Japan, because, of course, the Japanese had a base of savings to draw upon to force into the bond market, ultimately in a sort of what you could describe as financial repression. But this could actually go on for some years to come with a very stagnant economy and at the same time inflation.
Yeah, the only sorry to interrupt you, gentlemen. The only form of savings really most Americans have left at this point is their equity's gone in their house. The only form of savings the government can go into at this point for financial repression here in the United States, which is what the central planners want here in the United States. They want a controlled amount of inflation. They want nominal GDP targeting. They basically want worsening stagflation. To a certain extent. I mean, they're going to lie about the nominal numbers, but the only pool of savings they can really tap into that's left is the 401ks, the IRAs. So that would be, in my opinion, where they're going to go next. If there's a bond market type event or they're worried about one here in the United States, they're going to go after, they're going to require as a matter of patriotism, then, they're going to say as a matter of patriotism that each American citizen then is going to have to forfeit, 10% or 15% of their savings in their 401k is going to have to be used to purchase and hold U.S. Treasuries or something along those lines to start with. That would be my best guess.
That, Jason, is the road to serfdom, if I may say so. I think at last, from something that Ron was saying, I think I've got something I can disagree with on this, and that is the timescale for all this. I think Ron's argument is that we've got basically a stagflationary outlook on the prices of goods and services, which with financial repression could continue for some considerable time. I don't see that. And the reason I don't see it is partly because of things like the shadow banking system. You've got complete connectedness between America, Europe, Japan, UK, China, everywhere you like. And the problem is that if Europe falls over and I think that is going to be the event for 2013, that brings about a huge, great banking crisis, a global banking crisis. It's as simple as that. If Japan falls over, and that could be an event for 2013, again, you have got a massive banking crisis, not as bad as the European one, because the Japanese are actually far more self-financing rather than globally financed. But nonetheless, these are major events which will require a Lehman-type response from the central banks to try and keep the system afloat. So I can see that there would be a massive rescue operation in that event. Now, whether that is enough to topple the confidence in paper currencies completely or not, I don't know, but I suspect it could be the start of a major loss of confidence in paper currencies. Thoughts, gentlemen?
Well, if I could add to your guys' points here, this system can continue, this worsening stagflation that Ron and I have discussed at length in the past for many hours and that we're talking about now. This thing can continue as long as the foreign creditors in the outside the United States, the countries that are on U.S. dollar pegs, let it continue. That it's just that simple. So when the foreign creditors say that, okay, we're taking off our dollar pegs or we're repegging at a different price and we're not going to import any more of the inflation that the Fed is exporting to us, because we're in massive currency wars right now. I mean, there's people on Wall Street that are saying we're not in them anymore. We are. Okay, so the Fed doesn't see what it's doing then as, inflationary, because the Fed can basically get the inflation exported because of all the currency wars and the dollar pegs, and all the other countries want to keep the jobs, and that's the trade-off. Is that the countries are willing to import the inflation the Fed creates on these base money, stimulus programs, like quantitative easings and stuff, in exchange for the jobs. So whenever the foreign creditors, the people who have all those dollars in their bank reserves, in their central bank reserves, decide enough is enough, then that's when this whole system can end, or one of the mechanisms for when the system would end. That would be a humongous velocity of money spike. The inflationary expectations would ramp up. There's over, $9 trillion outside the United States. And that money then would start coming back to the United States and or other developing countries and looking to buy up assets.
Right.
So,
Yeah.
I mean, to say exactly when it's going to happen is a best educated guess scenario. I mean, no one knows for sure.
Well, nobody knows the future. Otherwise, the future would be less interesting for us. So, what do you think about these extraneous events, Ron? Do you think that is likely to derail your sort of long slide into stagflation and financial repression, or do you still see that as the most likely outcome?
Right. Well, rather than going into a lengthy discussion of hyperinflation, let's stay with that theme. That will there be a black swan event, whether it's a collapse in OTC derivatives and a domino effect of financial firm failures, or another financial crisis, or perhaps a collapse of Japan. These things could happen in the Japanese bond market specifically. These things could happen, and of course that would in fact provoke, there's no doubt, a massive monetary response. The question is simply whether or not that massive monetary response is going to trigger inflation. And so my argument would be that, in fact, we saw just such an event in 2008, and we saw a massive monetary response, and we did not see runaway inflation. We've seen inflation, and we are seeing continued inflation, and we've seen global commodity prices rise. We've had the Arab Spring, and what I believe is that if we have another crisis, whether it's almost regardless of where it's centered, but let's just say we have another crisis like the 2008 crisis in some sense, whatever the trigger might be, and we'll see a similar massive monetary response. And so I think we would see similar disruptions. We've already seen that the central banks can essentially step in, and governments can step in and hold the system together, almost defying gravity, against the rules of the market, against the laws of economics, and that although there is a great cost, they can prolong that impossible situation for much longer than anyone would have thought before 2008. In fact, really, we're 4 years on from the crisis, and the natural outcomes still haven't occurred. And so I think that if there's another round of the crisis, so to speak, or a new dimension to the crisis, that too will be sort of propped up, and we will again limp along. But the point is that there is a cost to all of this. And the cost is what I'm saying is financial repression or stagflation, and that is a cost, because you have. I mean, you mentioned a depression earlier. That essentially is the kind of economic environment you're looking at, where there's no growth, there's no opportunity, there's no upward mobility, there's a lack of lending into the real economy. So you have just a terrible environment. And ultimately, I think the crisis, the ultimate crisis, might come when the United States looks a lot more like Greece. But I rather think that's years away.
Yes. What was going through my mind as you were talking about, this sort of, if you like, the likely initial effect on prices, is that I think really what you're describing is a change in preference for money amongst consumers. In other words, if you get sort of the black swan event, then the initial reaction is bound to be for people to try and encash their bonds, encash their equities and other investments, basically because they have a changing preference for money. They prefer money more tomorrow than they did, let us say, today. Now, that does have a very profound effect on prices. So I would agree with you. The initial effect of such a catastrophe, a black swan event, would be for an increased preference in money, which has the effect of increasing its purchasing power, particularly against the assets which are being sold in preference for that money. But what we're looking at, I think, is the level of confidence that then resides in money after that is washed through, because that's very much a first effect, I guess. Have you any thoughts on that, Jason?
Well, there's so much inflation already in the global value chain, and that's when the U.S. prints money and the dollar pegs, and then the money is either speculated with by Wall Street in the capital markets, which is propping up asset prices too, by the way. And then that's what's prevented a stock market crash, because you have the revenues for a lot of these large firms, which has not increased. You have the profit margins, which is declining. I mean, you can only cut so much costs. And then you have the stocks, which are still going up. So that's really the only rational explanation, is all the money, it's going somewhere, it's not being held. But in terms of the real economy, there is just so much money globally, and this is because of the dollar peg. So when the Fed prints money, the money just leaks. So either it goes into the commodities markets first, it's speculated in there, and then it starts creeping into the global value chain. And once the inflation is in the value chain, there might be a period of time, after QE2, the inflationary expectations, velocity may subside a little bit. Gas prices have dropped a little bit, post QE3. And it's the prices have dropped a little bit in terms of that, but there's still inflation in the value chain. I mean, a lot of firms out there are very scared. They're trying to do more with less. They're really trying to run their business as efficiently as possible, and their margins are just being absolutely compressed to the point. And this is the problem with stagflation and financial repression, is most firms don't have their small businesses and entrepreneurs. They don't understand the world economy like we do, and they don't understand what's happening, and they're like, well, why is my profit margin dropping so rapidly? Why are my costs always going up? So this is what I deal with when I speak with entrepreneurs, and they're coming to a very tough reality here, that it's going to be a very tough growth environment, because entrepreneurs are just so optimistic. They want to grow their business. They see growth opportunities here, but in the United States, you have too many rules, too many regulations, too much red tape. You have Obamacare, which is going to hurt on the job growth creation side. And then you have the cost push and inflation, which is what Ron said here on the consumer staples and the other things. So it's a double whammy basically for the private sector. And then you have the government then, which is now basically cannibalizing a lot of the private sector too.
So, what you've described, Jason, I think we all suffer from. Now, what I'd like to suggest is that because Ron is closest to Japan, I'd be interested. Why don't you give us your thoughts on Japan? I will then impart my thoughts on Europe, and if we can ask Jason to wind up with his thoughts on precious metals, how does that sound? Would you like to start with Japan then, Ron?
Well, sure. I mean, I think that Japan is a basket case. The economy is obviously in a shambles, and the government debt situation is absolutely untenable. I mean, the debt to GDP, I don't recall the exact number, but I think it's around 200 or 300%. It's really quite ridiculous, and so. In that type of situation, the question being, how will Japan be able to fund its government, having already cannibalized the savings of its population? And at the same time, demographics are very much against economic growth in Japan. You have an aging workforce, so that means an increased burden in terms of social welfare programs, so retirement essentially. And so that's a situation where it's hard to see where growth can come from. It's hard to see where how the government can fund itself. And there is a massive quantity of JGBs, Japanese government bonds, and they're arguably overvalued. We've already seen 2 interventions to weaken the Japanese yen, which is interesting. Because the yen has strengthened after the Fukushima crisis, and in the face of what one would imagine would be a massive deflationary collapse in the Japanese bond market. But in fact, rather the opposite's happened. That the yen has strengthened, and central banks have had to intervene to weaken it. And I think that the main reason for that is that the dollar and the euro actually have simply are in a race to the bottom and are moving faster than the yen. I also think that the disaster in Japan caused a increase in demand for yen, perhaps because of domestic demand in Japan for the currency. And so from this point, you can only imagine the yen weakening. And you can only imagine Japanese bond yields creeping up, and it's hard to say whether or not the BOJ can really keep those bond yields down. But really, all the central banks are in the same type of situation, just in different stages of development. And there are some differences in the particulars, but in the United States, the demographics also are against the Fed.
If I can just going back to Japan very briefly, do you think it's significant, or what is the significance of their trade surplus apparently turning into a trade deficit? Is this a bit like the beginning of the end? Maybe does it reflect the drawing down of savings by the elderly, not being matched by new savings being created by the young, or is this something we shouldn't worry about?
No, I'm glad you brought that up. This is a crucial change, a sea change in the situation for Japan. And the only reason they've been able to do, and it's one of the key differences between Japan and the United States, the only reason they've been able to do what they have done is because of their exports. And in the absence of that export market, with the weakened European and United States economies, this is I don't really see how Japan can overcome that situation. So I'm also bearish on Japan. The outlook, I think, is really very negative.
Yeah.
If I could step in for a second about Japan, besides the Japanese corporations misallocating capital and resources, I mean, they've been buying up a lot of JGBs too. Their collectivist culture nature, their individual citizens, their corporations stepped in and did what they thought was right, and wasn't good for the individual, wasn't good for the economy in the long term, and they stepped in and bought the JGBs, like I said. And you're coming to watch this now with firms like Sony, which used to be the top electronics firm in the world, and these guys, like, they're still making some money, but their market cap has shrunk massively over the last decade. So there's other electronics firms that are doing much better, but the Japanese culture in general, I mean, they've condoned bad behavior. For lack of a better term, you have their citizens and their corporations who have condoned bad behavior, and now they're paying the price for it. I mean, they have stagflation now. I mean, we could debate about how much stagflation they have right now, but it's going to get worse as the central bank starts to massively monetize the debt. I mean, the currency is going to get trashed, in my opinion.
Yeah. Okay. That's quite clear. Europe. Where do we start with Europe? I mean, I can't find any sort of chinks of nice light coming out of Europe at all, because Greece and Italy and Spain and Portugal and Ireland, they're all bust, completely bust. Even little Cyprus is bust, and France is coming up on the rails as being the worst basket case of the lot. France is very different. It's not collapsing as a result of a property bubble collapse or anything like that, which I think is a fair description of Ireland, Portugal, and Spain. They're facing collapse simply because they are very, very controlled as an economy. The state runs everything. The state officially amounts to 56% of the economy. I should think by the time you take in the businesses which are entirely dependent on the state, I would be surprised if there's less than 30% of free market left. And most of that's black market. It's all sort of, done on market stalls and those delightful towns and villages throughout the centre of France. They really are facing the most appalling slide in industrial production. They are discouraging any wealth whatsoever. The cost of employing anyone is at least twice, depending which business you're in, at least twice anyone's salary, and you can't sack anyone. It's collapsing in the way in which those old communist bloc countries finally had to throw in the towel. And the only reason that interest rates are where they are is I think that money has been coming from Italy and Spain, from people frightened about leaving money in the Italian and Spanish banks, and they put them over the border into the French banks. And the French banks lend the money to the government, and that's why you've only got 2.1% yield on the 10% bonds. It is a crazy situation which will come to an end very, very soon. What brings it to an end, whether it collapses on its own or whether it collapses because other countries collapse before then, I don't know. I suspect other countries will collapse before France actually does, but France itself is a basket case. I've advocated in the past that the harder currencies should get out while they can, but I don't really see that happening because the politicians in Germany and the rest of Europe are just not prepared to consider anything other than just sticking together for the whole of the Eurozone to stick together. And here again, we've got the problem with the shadow banking system. The shadow banking system in Europe is about the same size as the shadow banking system in America. And all these banks and all this shadow banking exists on the basis of collateral, which is, in Europe, it's mostly government debt, which is just going round and round and round in circles, and all wildly overvalued. So my prediction basically is that the Eurozone will fall over in 2013, and I feel quite comfortable with that prediction. So unless you want to pursue the subject of Europe any further, I suggest that we ask Jason to wind up with his opinion on gold and silver.
I would say one thing, Alistair, which is that everything you've said is correct, and what you're predicting as the logical outcome is absolutely what should happen. But I would point out, and this is part of my view on the United States as well, that what should happen is precisely what doesn't happen, because market forces are subverted, accounting rules are suspended. So, we're in a world of central planning that would never have been imagined just a decade ago. And so the question is, how long can this really farcical situation go on? And I mean farcical insofar as, look, if you look at the numbers, let's say, for Japan or for Greece, and then you consider what these bailout measures and other supposed solutions are, I mean, it's really just absurd. I mean, obviously the problem won't be solved by any of these measures, just in the same way that the United States is heading towards the so-called fiscal cliff, but that's really just another marker on the road to a situation where there's really no way to end the expansion of government debt without a vicious collapse in the economy in the United States. Not to preempt Jason's summation, but these things are farcical. In other words, they're just totally. I mean, the natural market outcome is simply disallowed. And when you have, for example, the United States, the mark-to-market rule suspended in 2009, never put back, you're just talking about this sort of world where it's sort of a free-for-all. There aren't really any rules here. So, I mean, I understand that your belief that market forces will have a logical, predictable effect, but I think it's easy to underestimate the effect of just sort of changing the rules.
Yeah. Yes, I'm sorry if I can just respond to that. History tells me that you are right, Ron, that you should never underestimate the ability of governments to kick the can down the road one more time. But even taking that into account, I feel that we are very, very close to the end for Europe. It really physically cannot go on much further. You're getting regions in Spain, for example, trying to duck out of the problem by saying, we want to leave Spain. This is the situation that's developing in Catalonia. You have got riots on the street in places like Greece and so on and so forth, that governments have turned in on their people to stop the disintegration. The governments are destroying capital in the private sector at an ever-accelerating rate. The result is that the private sector economies in Europe, in these countries in particular, are collapsing. There is not really very much time left. I think it's as simple as that. But I do take your note about the ability of governments to put off the inevitable. Jason, you had something.
Well, I was going to say that the Fed, in terms of Europe, like you mentioned the fundamental problems and how things are worsening on Main Street in Europe. But what the Fed might do then is continue these currency swaps, and they might just try to, because they're not going to see any repercussions for them right now because the velocity of money is so low, they might just start giving Europe or the ECB $1 trillion a month in currency swaps. I mean, there's very little to stop it at this point. There's very little to stop that.
I think no, that's absolutely right, Jason. I think we would all agree the one thing that's likely to come out of this is that every crisis will be just met by a flood of money by the central banks. That is their gut response, which I think probably, because we don't want to take too much time, probably brings us on to your views on gold and silver, Jason. If you could wind up this debate for us.
Okay. Well, I would say that there's a permanent price floor now in gold and silver, and to a lesser extent oil. Let me outline why I think there's permanent price floors in gold and silver. Okay, you have all these central bank interventions, and the people who want to maintain the status quo, the economic and political elites, because we have a managed economy, a politicized economy. So they're going to print the money because they don't see the repercussions, or they don't care about the repercussions, because if they lose their political position or their economic power right now that's tied to the large governments, they're done. So they're going to do what it takes in terms of printing money. And in terms of the fundamentals of the gold and silver market, you have central banks which are continuing to add gold. In terms of the individual citizens here in the United States, there's been a brief pause in the amount of gold. The gold sales have dropped a little bit. The silver sales have dropped a little bit. But central banks are still massively buying, net buyers of physical gold. And then you have Basel III. I think Basel III is a potential big-time game changer that the market is not pricing in right now. For your listeners out there, that's January 1st, I believe, of this new year coming up, where banks then can hold 100% good collateral then of their gold. So there's now the incentive in place for, instead of banks to short their gold or lease or swap it out or whatever now, there's going to be incentive now for the banks to start repairing their balance sheet, rebuilding collateral, and buying and holding physical gold. So I think these games then are going to be switched, because you're going to see more people want to go on the long side now and hold physical gold because they're not going to trust their counterparties. I mean, a lot of the stuff you just mentioned with the banking system, with the governments, there's counterparty risk in these over-the-counter derivatives and these sovereign bonds because you're not going to get paid back in real terms. So, I mean, this all roads, inflation or deflation, in my opinion, this is going to lead to gold. No matter what your definition is, I think gold's the main winner.
Yep, I think I think that's a very, very fair point. Jason, do you have any view on some of the scandals that seem to be emerging amongst the central banks? I mean, the Bundesbank doesn't seem to know where its gold is. It sort of thinks it's somewhere in New York, but it hasn't looked at it for a long time. We find that the Austrians, who I know have only got about 200 or 300 tons of gold, have been leasing it out and have been proud of the $300 million income they've got from leasing, but again, haven't really got a clue where it is, other than somewhere in London. Do you have any view on that? Do you think there are going to be more stories like that coming out of the woodwork?
Oh, for sure. And a lot of allocated accounts have been raided too. I mean, the way the GLD and the SLV are set up, it's set up so it's just people can be paid back in paper. And only the people, the really large shareholders, the high Wall Street people, the high net worth people are allowed to actually remove the gold and silver. And normally they remove the physical, to put out fires elsewhere when people demand physical. So, I mean, these things are meant to postpone the massive price spike. So in my opinion, I think we're going to see a managed increase in the price of gold and silver. I mean, we could have free market forces eventually as more people learn the truth. But ultimately, like everything here just starts, I mean, this whole discussion, it starts with ideology. From Japan to the United States to Europe, there's just so many people right now, and this is why the crisis has postponed so long, who don't know what capitalism really is. Okay, that's what it boils down to, is they've been taught at every level of school, basically through the university level system, that, running a business, being an entrepreneur, making a profit, a lot of them have been taught it's evil. And you have to have businesses. You have to have people. I mean, there are businesses that do a bad job, that are rent seeking, that don't focus on long-term value creation, but there's plenty of good businesses that run an efficient firm, that make a profit, that treat their shareholders well, that treat their customers well. And people need to learn. This starts with the ideology problem, is that, people, when things go bad or the economy's bad, they expect the government to do this and this and this. And there's just a lack of personal responsibility now. And it's just because people don't understand capitalism and personal responsibility anymore on a global scale, in my opinion.
Yeah. Well,
I would like to,
yes, quick opinion on gold, Ron, please.
Well, I would like to interject one last thought, and that is that, it is entirely possible that the outcome of this tendency towards central planning and monetization and intervention into the economy, and just what Jason is saying about the movement away, at least ideologically and also economically, away from free markets and away from genuine capitalism, it's entirely possible that the outcome of that situation is a completely collectivist system, that we move to a system of 100% government ownership of the means of production, and that it's entirely possible that will be the ultimate outcome. Now, as far as the metals are concerned, I think that certainly the price of gold will continue to rise because of not just central bank buying, but demand in the emerging markets, and especially in India and China. You just don't see how the price of gold can really fall down and stay down for any length of time. I think there's strong support for the price of gold. And, I would disagree a little bit with what Jason said insofar as I just don't think the words public and awareness should really be used in the same sentence, because this idea that people will sort of wake up and understand that their value of their money is being inflated away, I rather doubt that any substantial number of people will understand that reality unless or until inflation greatly accelerates from the current point. In other words, for most people, it would just be too late for them to make take any steps to protect their wealth through precious metals.
Yeah, I think that's we're a long way from that sort of wide understanding. I mean, certainly a long way. Well, I think we've taken an hour of our listeners' time. So thank you, Jason Burack of Wall Street for Main Street, and thank you, Ron Hera for Hera Research. This is Alistair McLeod.
Thank you.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.